And now, ways and means of monetizing the top telecoms for 2018. Yes, indeed, telecoms have been very, very good to the ASK THE WIZ Wealth Institute family, and we've gotten P.A.I.D consistently from telecoms. But we now must go ahead and reevaluate which are indeed the best telecoms to get us P.A.I.D throughout 2018. So let us now form one mastermind and do just that. Now, telecoms are indeed ideal holdings for income investors. Now, the list is diversified amongst high yield and dividend growth positions, and is diversified geographically as well, this list I'm about to give you. And all 5 of these positions have strong brands and generate enough cash flow to grow the dividends over time, and we must see dividend growth in positions that are paying dividends that we have in our portfolio. Now, telecom stocks are ideal selections for you, me, we, the ASK THE WIZ Wealth Institute family, as we are indeed income traders and investors. And they're ideal because of their high yields and annual dividend increases. Now, with interest rates still very low, although the Fed and the new Fed Chairman Jerome Powell says he's going to increase interest rates. But as I speak to you now, interest rates are still very low. And the S&P 500 index average dividend yield is at just 2%. Telecom stocks can provide you, me, we, the ASK THE WIZ Wealth Institute family with several percentage points of additional yield. Now, with that in mind, I have created the following list. A list of the top 5 telecom stocks for 2018. And I have also compiled a broader list of dividend-paying stocks in the telecommunications sector, which I will be presenting to the ASK THE WIZ Wealth Institute in a separate reference document. Okay, and it has over 138 telecom dividend positions on that one. But today, during this brief period of time that I have with you here inside the classroom at Walls, I'm going to give you the top 5 positions. Now, the 5 stocks on this list that I'm about to give you are indeed a diversified group. The list contains high-yielding stocks, dividend growth stocks, international companies, and even a stock that pays its dividend on a monthly basis. So now, without further ado, here are the top 5 telecom dividend-paying stocks for 2018 in no particular order that will get you P.A.I.D. First position I'm going to start out with is AT&T, symbol T, has a dividend yield of 5.1%. Now, first and foremost is the big boy, AT&T, which is something of a no-brainer for income investors looking for high yields. You see, AT&T has virtually all the qualities that income investors look for. It has strong cash flow, a high dividend yield, and this particular position is in a group of stocks that has paid dividends and increased its dividends for 25 years consecutively. Now, AT&T has increased its dividend for an impressive 34 years in a row, including the most recent increase on December the 15th of this year, 2017. And not only is AT&T the only telecom stock on this particular list I'm about to give you, okay, but it also has a high dividend yield. Now, AT&T is one of many positions that pay a dividend consistently, but it is also one of the strongest companies that pays a dividend consistently. Now, AT&T grew revenues and adjusted earnings by 12% and 5% respectively in 2016. And the numbers are not out yet for 2017, for the year has not completed. Growth was boosted by its $48.5 billion deal for satellite TV provider DirecTV back in 2015. And financial results have deteriorated slightly over the course of 2017 as the company revenue has indeed declined by 2.5% over the first 3 quarters. The good news is AT&T wireless and video business continue to perform very well. Now, AT&T added 1.5 million prepaid phone subscribers and another 600,000 postpaid smartphone subscribers last quarter. And it has had its best ever third quarter churn of 0.84%. And as a result, the company racked up record wireless margins of 42% last quarter. Now, going forward, AT&T futures growth would be helped greatly by the pending $85 billion acquisition of media giant Time Warner. Now, Time Warner has a number of valuable assets, including TBS, TNT, HBO, and Warner Brothers movie studio. So, the acquisition would create an industry big boy, indeed, with over 140 million mobile subscribers and another 45 million video subscribers around the world. In addition, AT&T would gain a hedge against rising content costs. But the one potential snag is that this particular deal may not receive regulatory approval. You see, it was back in November of this year, the Department of Justice sued to block the proposed transaction on antitrust grounds. Now, AT&T remains unwilling to sell off a significant amount of assets to get the deal done, which casts doubt over the acquisition. Now, there is a trial that is set for March the 19th, 2018, pertaining to this matter. And if the deal does not go through, then AT&T's future growth would be diminished. Fortunately, AT&T's dividend is indeed secure, with or without the Time Warner deal going through. For example, AT&T has adjusted earnings per share of $2.27 through the first 3 quarters of 2017, and it's paid dividends totaling $1.47 per share in the same period. So this gives the company a very manageable dividend payout ratio of 65%. AT&T, symbol T. Next great telecom position I want to give you for 2018 is Verizon, symbol VZ, dividend yield of 4.4%. Now, the next best choice to AT&T is Verizon. And once again, that symbol is VZ. This is the other huge U.S. telecom provider. Now, Verizon has increased its dividend for 11 years in a row, okay? And the company's growth has ground to a halt over the course of 2017. You see, Verizon is perhaps the most heavily impacted telecom by the ongoing price wars in the wireless industry. It has been hurt particularly hard, okay, by lower cost carriers like T-Mobile. Now, Verizon decided to match unlimited data offerings utilized by competitors such as T-Mobile, which has weighed on its margins. Verizon's operating revenue declined by 1.7% over the first 3 quarters of 2017. Free cash flow has declined 6.1% in that time frame. And in response, Verizon launched a major cost-cutting program. The company called SG&A. They cut the SG&A expenses by 20% over the first 9 months of 2017, and is targeting $10 billion in cumulative cash savings over the next 4 years. Now, for the full year, Verizon management experts expect organic revenue and earnings per share roughly even with last year. And there are a number of catalysts in the works for 2018 and beyond. Now, Verizon's most compelling growth catalysts are the 5G network that they're rolling out and the Internet of Things. Now, Verizon stated in its last year's annual report that 5G speeds are 100 times faster than current wireless technology. And Verizon is quickly ramping up in spectrum capacity for 5G with the $3 billion acquisition of Straight Path Communications. Now, Verizon is conducting 5G pilot programs in 11 U.S. cities. In addition, the company will roll out 5G broadband services in 5 U.S. markets in 2018. Another catalyst, as I mentioned, is the Internet of Things, which will power connectivity of far more devices than just smartphones and tablets. And Verizon has made multiple acquisitions to boost its Internet of Things business, including the $2.5 billion acquisitions of Fleetmetrics, and the $900 million acquisition of Telegis. Now, telematics revenue was over $220 million last quarter, including Fleetmetrics and Telegis. Now, Verizon exceeds $1 billion in internet revenue in 2016. They exceeded $1 billion in Internet of Things revenue. The total Internet of Things revenue on an organic basis increased 13% last quarter for Verizon. But in the meantime, in between time, Verizon has an attractive 4.4% dividend yield and grows the dividend each and every year. On September the 7th of this year, Verizon increased that quarterly dividend by 2.2% to 59 cents per share. The dividend is indeed secure, and Verizon had a payout ratio of 63% over the first 3 quarters of 2017. The next telecom communication position that will get us P.A.I.D. throughout 2018 is Vodafone. Vodafone, symbol VOD, pays a dividend yield of 4.7%. Now, Vodafone is an attractive telecom, and it pays a dividend. And therefore, it's an attractive telecom dividend stock for 2018. Not just because of its high yield, no, but also because of its international diversification. Now, Vodafone, as I indicated to you, trades under the symbol VOD. And Vodafone is based in Europe, but traded here in the United States under the symbol VOD. Now, Vodafone's organic revenue increased 1.7% over the first half of 2017. And cost cuts fueled 13% adjusted EBITDA growth in that time frame. Now, for the full year, the company expects adjusted EBITDA growth of 10%. Now, Vodafone's future growth could be even more impressive, beloved, particularly because its leadership position in the emerging markets that it holds. Approximately 23% of Vodafone's revenue is derived from Mother Africa, the Middle East, and Asia, where there are many premier emerging markets. Now, revenue from this particular segment rose 7% in the first quarter and 6% in the second quarter. This was far higher growth than Europe, which was up just 0.8% in the first half. Now, going forward, Vodafone is making a huge push in India, which has a rising middle class and high economic growth. And India has typically been a challenging market for telecom providers because it is highly fragmented. However, this stands to change, and the market in India is rapidly consolidating. In 2017, Vodafone's India segment merged with Ideal Cellular, and the deal gave Vodafone a 45% stake in Vodafone Idea. Now, Vodafone will be the largest owner of spectrum in India. That's very important, family members. Remember that now. Vodafone will be the largest owner of spectrum in India. The acquisition also gave Vodafone the #1 market share position across many portions of India. And Vodafone has already seen the effects of consolidation over the course of 2017, which included improved pricing and greater profitability. Now, Vodafone pays a semi-annual dividend. Okay, so it just pays it twice a year. And Vodafone's last 2 semi-annual dividend payments totaled approximately $1.50 per share for holders. And this represents an annualized dividend yield of 4.7%. The next, believe it or not, telecom communication position I want to give you that will get us P.A.I.D. throughout 2018 is Comcast, symbol CMCSA. Now, Comcast is not a traditional telecom stock, and it only pays a dividend yield of 1.6%. But it does have a significant media arm, NBC Universal. And so therefore, not many people consider it as a traditional telecom stock. This business, talking about that NBC Universal, contains a movie studio and theme parks. However, Comcast is increasingly becoming a fierce competitor in the telecommunication services, okay, and is becoming a fierce competitor to AT&T and Verizon. Comcast already competes with the U.S. giants in cable and broadband. And with the recent rollout of Infinity Mobile, it is a competitor in wireless services as well. Okay, talking about that Xfinity Mobile rollout that it just set forward. Now, just as AT&T is making a major push into content and media, so is Comcast. In 2013, Comcast acquired the remaining 49% of NBC Universal. It didn't already own that portion, so they went ahead and acquired it for $16.7 billion. And last year, Comcast acquired DreamWorks for $3.8 billion. And as a result, media now accounts for roughly 40% of Comcast's annual revenue. Now, NBC Universal grew revenue by 7% in 2016, and NBC Universal's EBITDA increased 13% per year from 2009 through 2016. Now, the NBC Universal acquisition also gave Comcast a large theme parks business, which generates 13% revenue growth last year. And the core cable business is still growing. Comcast is one of a few major service providers, which provides and leads to healthy margins and pricing power. Internet service revenue increased 9% last year for Comcast as well. So as you see, overall company-wide revenue increased 8% in 2016. Earnings per share increased 10% for the year. And Comcast has continued to post strong growth to start 2017, and it is rolling that into 2018. Now, revenue and adjusted earnings per share increased 8.2% and 22% respectively in the first 3 quarters of this year. High-speed internet and video led the way with 9% and 4% revenue growth respectively. Now, Comcast is a relatively low-yielding stock, particularly for telecom, but it makes up for a low yield with high dividend growth rates. Over the past 5 years, Comcast has increased its dividend by 14% per year on average. And at that growth rate, family members and listeners alike, Comcast dividend would double every 5.1 years. That means in 10 years, those of us who invest in Comcast today would earn a yield on cost above 6% if Comcast continues to increase its dividend by 14% per year. And the last position I want to give you, okay, for consideration, as a telecom that will get you P.A.I.D. throughout 2018 is Shaw Communications. Shaw Communications trades under the symbol SJR. Now, like Vodafone, Shaw is a pick to capitalize on growth outside of the United States. Shaw pays a dividend of 4.1%. SJR is a diversified telecommunication company based in Canada. It offers consumers wireless, business infrastructure, and business network services. Now, Shaw is a unique company, a unique stock, not only because it is located in old Canada, but also because it pays a monthly dividend. I said Shaw, symbol SJR, telecommunication company that pays a what? Monthly dividend. Now, Shaw is a company whose current monthly dividend rate is approximately 9 cents per share in Canadian dollars. Now, on an annualized basis, this comes out to roughly $1.19 per share. Since Shaw is based outside the United States, the dividend is exposed to currency risk. Please be aware of that. And based on current exchange rates, Shaw's dividend comes out to approximately 94 cents per share in U.S. dollars. Okay? Now, the stock trades for approximately $22.77 per share, plus or minus, which means Shaw has a current dividend yield of 4.1%. Now, the fundamentals of the company are in very good shape. Revenue increased 8.1% in 2017, while diluted earnings per share from continuing operations increased 12%. This growth was largely the result of 2 significant strategic initiatives: the $1.6 billion acquisition of Wind Mobile and the $2.65 billion divestiture of its media arm in exchange for an equity investment in Chorus Entertainment. Now, Shaw's portfolio adjustments have streamlined this business model and given it greater efficiency and improved growth prospects. Now, the Wind Mobile deal allowed the company to expand its wireless products and their wireless product offerings, and also gave Shaw a significant increase in spectrum. It also delivered scale benefits to the company, which contributed to Shaw's strong earnings growth last year. Now, Shaw has racked up 3 consecutive quarters of net subscriber growth, thanks in large part to the company's booming wireless business. And Shaw has a net gain of 25,000 subscribers in fiscal year 2017, which completely reversed a loss of 170,000 subscribers the previous year. And wireless led the way for Shaw with 103,000 subscriber additions in 2017. This drove 11% revenue growth for wireless services in the most recent quarter. And another important consideration, beloved, pertaining to this particular company and investing in foreign companies is withholding taxes. Dividends received in Canadian dollars are typically subject to a 25% withholding tax, family. However, there is an exception for Canadian stocks. The withholding tax is waived for U.S. investors who hold the stock in a qualified retirement account, such as a 401k plan or a IRA. So family members, I want to leave you with these parting thoughts pertaining to these very, very powerful telecommunications companies that will get us paid throughout 2018. Traders and investors typically buy telecommunication stocks for high dividends and steady dividend growth. These 5 positions that I just submitted to you offer a mix of high yield and dividend growth thanks to their stable business models and strong cash flows. Now, it's unlikely that consumers will go without cable TV, wireless, or internet services anytime soon. And as high demand for their products and services continues to grow, it allows these telecom providers to charge higher prices and raise their prices over time. This gives them the high cash flow that fuels their generous dividend payouts. Family members and listeners alike, we need to be interested in generating higher levels of investment income in our portfolios in 2018. And as a way and means of doing that, we would be wise to consider telecom positions such as the 5 I just submitted to you.